Welcome to this explainer. Today we are unpacking what I think is a pretty massive secret, how incredibly ordinary habits create, well, absolutely extraordinary wealth. Let's completely strip away all that confusing financial jargon right off the bat, okay? Let's just start with two friends who graduate from college on the exact same day. They both land similar jobs, they earn almost the exact same starting salary, and they both dream of one day becoming financially free.
But here's where it gets interesting, because their paths diverge, like, immediately. Friend one, they take that fresh paycheck and just spend every extra dollar on immediate gratification. You know the drill. The latest gadgets, expensive dinners, super fun weekend trips. Friend two, on the other hand, isn't inherently richer, they aren't smarter, and they definitely aren't luckier. Instead, they just make one really simple, quiet decision. Every single month, before buying any extras, they invest a small portion of their income.
Fast forward 20 years, their financial realities are completely opposite now, despite having the exact same starting line. Friend one is basically still working paycheck to paycheck, heavily dependent on their next salary just to keep the lights on. But friend two, wow. That small, quiet monthly habit has grown into a portfolio worth hundreds of thousands of dollars.
Okay, so let's dive into this for a second. What actually made the difference here? Was it a stroke of genius intelligence? Actually, scratch that. Maybe it was just incredible luck, or a suddenly high-paying career that caused this massive wealth gap. The answer might genuinely surprise you, because it was literally none of those things. It was just simple investing.
Section 1. The Myth of Instant Wealth.
Look, when we think of investing, we usually picture those chaotic Wall Street trading floors, right? Complicated charts, or people trying to hit the jackpot with crazy, high-risk bets. But in reality, it's a lot more like planting a tiny seed. On day one, you plant it. And the next day, absolutely nothing impressive happens. You might see a really small sprout months later. But years later, that tiny seed becomes a massive tree, providing shade and fruit. With real investing, you have to let time become your business partner, rather than expecting instant results. Nature doesn't rush, and honestly, neither does durable wealth.
Section 2. The Magic of Compound Growth.
Wealthy people understand this really powerful secret. Every single dollar you invest acts like a tiny, tireless employee. This expanding workforce is driven by compound growth. Now, what's that? It's just the process where your initial investment earns returns, and then those returns are added back in to generate even more returns. It's literally a snowball rolling down a hill, gathering more snow and momentum entirely automatically. Your money just starts building upon itself.
This concept is so legendary that Albert Einstein is actually often credited with calling compound interest the eighth wonder of the world. Now, whether he literally said that or not doesn't even matter, because compounding is treated as an absolute force of nature in the finance world. You aren't just earning money anymore. You are earning money on the money your money made.
Say you invest just $100 every month. It might not feel life-changing at first, but eventually you hit this magical crossover moment. The massive exponential returns generated by compounding become significantly larger than the effort and money you're adding yourself. That is the exact moment your money is officially working harder than you are.
Section 3. The Cost of Waiting.
Unfortunately, people make one massive mistake that completely disrupts this beautiful process. They wait. I'm sure we've all said or heard at least one of these excuses. Oh, I'll invest when I earn more. Or, I'll definitely start next year. Or, I'll begin after paying off absolutely everything. But waiting is kind of like standing at a train station. Every year you wait, a train leaves without you. Missing one train might not seem like a big deal, but missing 10 trains? That changes your entire destination.
So, the absolutely crucial takeaway here is that time is the greatest investment multiplier you will ever own. Starting early matters far, far more than starting with a large amount of money. A small amount invested today is vastly more powerful than a large amount invested a decade from now, purely because of the compounding time it has to grow.
Now, with all this talk about starting early and compounding, you're probably asking yourself the most practical question of all. How do I put this into practice today? Like, what should beginners actually invest in to get this snowball rolling?
Well, the answer from the financial community is honestly overwhelmingly straightforward. Experts consistently recommend diversified index funds, or ETFs. That stands for exchange-traded funds. These are simply investments that take your single dollar and spread it across hundreds or even thousands of different businesses at once. You aren't out there trying to find a needle in a haystack, you are just buying the whole haystack.
The benefits of this approach are just massive.
By holding many baskets, instead of putting all your eggs into one, you massively reduce your risk. If one company in the ETF struggles, it doesn't destroy your financial future because you own thousands of others. It lets you participate in the long-term growth of the entire economy without having the impossible task of predicting tomorrow's single superstar company. History consistently proves that over long periods, economies expand and markets grow.
Of course, we know there will be scary headlines, right? Market storms are going to happen. When the market inevitably takes a dip, inexperienced investors completely panic and sell. They lock in their losses out of fear. But experienced investors, they see a market drop as an incredible 50% off store sale. They don't run out of the store. They buy more while things are cheap.
Section 4. The simple investment strategy. Consistency.
Surviving those market storms relies on basically one blueprint. Start small, learn continuously, invest consistently, and above all, stay patient. It's just like going to the gym. One single dramatic workout isn't going to transform your physical health, but hundreds of consistent, moderate workouts over several years absolutely will. Investing the same amount consistently, month after month, naturally averages out the prices you pay and entirely removes panic and emotion from the equation.
Section 5. Investing for freedom.
If you project yourself 20 or 30 years into the future right now, your older self will likely only have one single regret. I wish I had started earlier. Because ultimately, money itself isn't the destination. Freedom is. Investing is simply the vehicle that buys you the freedom to choose a career you genuinely love, the freedom to retire comfortably when you want, and the freedom to spend your days with your family without that constant heavy burden of financial stress.
Returning to our two friends from the very beginning of this explainer, it's crystal clear now, isn't it? They had the exact same opportunities, education, and income. But the staggering difference in their lives wasn't born of some hidden Wall Street secret. It was born of time, discipline, and consistency. It was simply planting seeds today to grow into a massive tree of financial freedom tomorrow.
There's a famous saying, the best day to start investing was years ago, but the second best day, that's today. Your wealth is built by small, smart decisions made repeatedly over time. So what's it going to be? Will you spend it all for a fleeting moment today, or will you plant your seed right now and truly buy your freedom for tomorrow? The choice is entirely yours.